Are you curious about the most undervalued stock? Hey, and welcome to another video here at FiscalVoyage. My name is Felix, and today's video we're going to talk about the most undervalued stock right now that you could purchase with a high current dividend yield. The most undervalued stock, British American Tobacco, ticker symbol BTI. As you can see here, the company before the economic shutdown was around $45 to $44, even though it's $43. And since the economic shutdown as March 23rd low, the company was $27.64, and it's been up since then. But right now, it looks like in a downtrend, going for $34.29. But later in this video, I'm going to show you why this company I considered the most undervalued right now. But before we do, let's look at the earnings release. They released this report on July 31st, 2020. As you can see here, revenue was up about 0.8%. Adjusted revenue was up 1.1%. And Jack Bowles, the chief executive, said the business is performing well in difficult circumstances as our continued focus on the three key priorities has enabled us to rapidly adapt to the current environment. So this is a good statement here. As you can see here, 10% of the revenue came from non-combustible categories, and they're making good progress towards their target of 50 million non-combustible consumers by 2030. And you see here, our non-combustible consumers base increased 11.6 million, up 1.1 million from December 2019. So in their non-combustible business is growing, as well as their cigarette volume share is up 50 basis points and value share up 20 basis points. So we look at their fiscal 2020 outlook for the next 6 months. Consistent currency adjusted revenue growth between 1 and 3%, which is in par with their most, this quarter release, and a mid-single figure constant currency adjusted diluted earnings per share growth. Again, I always like earnings growth. This is how companies are able to continue maintaining their dividends and the the payout ratio of the dividends. So here's a breakdown of the revenue. As you can see here, the new categories is up 14%, where vapor is up 40%, and modern oral is up 67%. So this is where a lot of the growth is coming in. As you can see here, profit from operation on all the geography is up 16.4% versus 2019 reported first half, and as well as operating margin is up 550 basis points, and earnings per share is up 22.7%. So that's great. So as you can see, the company is growing, and you can see here free cash flow before payments of dividend was 2.3 million versus now after payment, so they're left with 51 million. So let's look at the fast graph for the British American Tobacco Company. You can see here the black line is the monthly closing price, the orange is the earnings with a multiple of 15, and the blue is a normal PE ratio of 13.7. We could say 14 for a normal PE. And the little dots are when I bought shares of the company. I first initially bought shares at $35.59 and $33.37. That's when I bought shares of this company. And you can see earnings has been at a consistent growth rate. In 2008, 2009, of course, the financial crisis, it dropped about 15%. And in 2014, earnings dropped 10%, and 2015, 5%. Of course, this is during some changes, most likely. Leave you guys for research, what happened there. But you can see in 2017, earnings grew at 28%. It was flat in 2018, and in 2019, 6% growth, and a consistent earnings estimates of 4%, 6%, 8% growth. So we show in this graph here, you can see the company is way undervalued based on the normal multiple of 15 and the standard 15 PE. Right now it has a PE of 7.9, and because of that, if it were to go back to a PE of about 15, you can see a total annual rate of return of 45% in the next 2 to 3 years. So that's outstanding. This is why I consider this company the most undervalued stock right now. If we look at the forecasting, there's you got here 21 analysts estimating the company for 2020 full earnings and 2021 earnings as well. And you can see here 3 months ago, analysts, because the economic shutdown and uncertainty, analysts had projected earnings for 2020 of $4.16, but because they announced the quarter release for second quarter in the first half of the year and their estimates, they actually increased their earnings to $4.33. So that's an improvement. So I like that. As well as for 2021, you see here was $4.39, and now they're estimating $4.59. So that's an increase as well. So this is from 21 different analysts. They all have an estimated average growth of 7.2% or 12%. And as you can see here, for the next year or two, if the company were to even just be at a PE of what we got here, 12, you could see a total annual rate of return of 50.8%. So that's outstanding rate of return. And not only that, you have a amazing yield of 9.8% currently. So, and if we look at free cash flow, let me go back here and let's look at free cash flow, so you can see the coverage of the dividend, because obviously the higher the free cash flow, the more certainty of the dividend. And there was some time in recent years, where the company free cash flow was slightly lower than the dividend. For example, in 2017, they had a free cash flow of $2.21 per share, and versus the dividend of $2.60. But they had a big increase in 2018 to $4.67 versus the $2.56 dividend. And the change in dividend is because this is a British company, and so currency adjusts changes. So that's why you see a down dividend from 260 to 256. It's not because they cut the dividend; it's just currency. But you can see here in 2019, they is up $2.65. Of course, this is because of the currency conversion. But anyway, you can see here the dividend is very well covered. This is the payout ratio here. And based on free cash flow and 2020 expected earnings, the payout ratio is only 67%. And for 2021, it's going to be 62.9%. So the dividend is very safe based on free cash flow. And that's very important because they have a high dividend yield currently. So let's look at the analyst scorecard, because if the company, these estimates look great, but are the analysts accurate? And you can see here, they've been right 73% of the time for the 1 year forward with a 10% margin error, and for the 2 year forward, 73% correct as well with a 20% margin error. So I'm very confident in these estimates. So 2020, I'm pretty sure that the company is going to be around $4.33 more or less, and for 2021, $4.59. So that's a nice growth. As you can see, mid single digit here. So we look here at when I bought shares. About here, we're going to use the higher point. I'm basically flat right now. You can see I'm only returning 4.7% annually, but most of it growth is I'm down 5%, but most of it is because of the dividend. So the total return has been 8.2% because of the high dividend yield. But I'm still holding this company, and I may actually be interested in buying shares right now, because I think this company is the most undervalued stock right now. And you can see here, like I showed you earlier, you have a huge potential of growth here, of high return of 45% annually. So that's real good. Even if the company is half correct, you're making 20% annually rate of return if it were to revert back to its mean. And as you can see here, the company does more or less go back to this PE of 15 and 14. There's been time of overvaluation here, and because of that, it reverted back to this mean, and then it's been down since then. But over here, it reverted back to this mean, and then it continued with a 15 multiple or 14 multiple. And right now, like I showed you, it has a PE of 7.9. So if it were to go back to this, even if it were to go back to 13 PE, this company has high return possibility. You can see here with a PE of 13.7, you could have a total annual rate of return of 40%. And even if it's flat, for the next 2 years, you're still making 9.8% a year because of the dividend. So it's kind of like a win-win situation. And again, if we look at the free cash flow, the dividend is very well covered based on these estimates. And you can see in the earnings report that the revenues are growing, not tremendously, but it is growing. So they'll be able to, with the operation profit and such, continue covering this dividend. Look at the 3-year, 5-year analysts forecasting. Let me change this to adjusted operating earnings or non-GAAP. You can see here, like I said, if we were go to 2022 and had a PE of just 12, you see a total annual return of 31.33, and there's only 2 long-term growth analysts here. They're expecting 4% for the long-term growth, but even at 4%, because of the valuation so low, this company could provide tremendous growth opportunity and increase your portfolio. This is why I have shares, and I continue to hold shares. As you can see here, I bought it at on 2018, November 2018, and I bought more in December 2018. And since then, I haven't bought because it's been up and down slightly here. But right now, it definitely looks like a promising positioning time to buy, and the stock is actually up 1.39% as of this morning. Let me refresh that, 1.15%. So there you have it. British American Tobacco is the most undervalued stock right now. I own shares of this company. I'm very happy with my current position. I most likely might be buying more shares, but I think you guys should definitely spend more time in researching this company. Right now, the dividend is about 8%, so it's real great. So even if the company is flat for the next 2 years, you're still making 8% of your money, and the dividend is growing every year as well. So thank you for watching. Also, make sure to check out my free ebook in the description below. Is a 5-step or 5 metrics to look for before spending more time in any company. And if you're new to the channel, make sure to hit that subscribe button, and if you like the video, hit that like button as well to help with the YouTube algorithm. So thank you for watching, and I'll see you guys in the next one.